Welcome to Money Matters. I am Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors, and I am joined, as always, by the wonderful and amazing DCrowell of Mortgage Network, and we are here to discuss all things where your money matters. So we sort of have, I don't know if you want to focus on the white noise that is going on around us these days, sort of the standard issue white noise that sort of detracts us from the focus that we should have, which is our personal financial planning and all of that. But we have lots of white noise around us, and so I think we're going to start with some of that today, and then talk about how it impacts our personal financial plan.
And it's perfectly clear to me why Emily has tossed the ball to me, because I am the captain and supervisor of white noise on Money Matters. If there's any white noise that's going to be brought up as a topic, I'm sure it'll be the one to bring it up.
It's always exciting, though.
It's always exciting.
It is.
So here.
And enlightening.
And enlightening.
It's enlightening white noise.
And hugely intelligent. So let me throw a couple of hand grenades in here. We have jobs numbers out this morning. This is a Friday morning that we're taping. It's Friday morning the 1st, so when you see this segment, there'll be further news. But the jobs numbers just came out about 25 minutes ago. The jobs numbers are disappointing. They were off by 20,000 non-farm jobs, another 20,000 IT jobs, another 30 or 40,000 in revisions from June and July.
How are they off so much in June? How can you be off by 40,000 jobs a month ago? How does that happen? And why do they have to keep?
Apparently, it's a very difficult calculation.
I mean, it's not 2,000; it's 40,000. It's like, those people really weren't employed.
There have always been revisions, so I don't know what the.
And sometimes they're massive revisions. Just makes you wonder, how are they off that much?
But what it does show is that the unemployment rate has ticked up very slightly from 4.3 to 4.4,
which is a bogus number anyway.
It's only a bogus number when you're on the other side of it. When you're on the flip side of it and want to show that the economy is improving, then you cling to the lowering of it,
right,
like the Dickens. All of these statistics are subject to a good bit of jawboning. They're not exact, but the trend is a slightly slower economy. What we have very resilient in this big economy, very resilient, is slow growth, very low inflation, and very low job hourly earnings growth. And now the hourly earnings is unfortunately a stat which is calculated across the labor market. So it includes people like me, and it includes somebody who's earning minimum wage. And it makes it kind of not as accurate as it might be.
They try to portray that number as an indicator of what the middle class in the United States is earning and whether they have real wage growth or not. I don't even know how you would define middle class in the United States anymore.
You really have to go more granular to get a sense of wage growth, and then you have to go market by market. So if you're in Hilton Head at the moment, hourly wage growth has increased dramatically for the least paid sector of the economy. In other words, the folks that were earning minimum wage a year or 18 months ago are earning $1 or $2 above minimum wage right now, or 3 or 4, because of the extreme labor shortage. Mm-hmm. That may be very different in Hardyville. That may be very different in Brunswick. I mean, you have to go really granular to get a sense of it and to adapt the statistic.
But if you're looking at the forest for the trees, it is still growing. I mean, we've actually looked in previous episodes at what real wage growth, that's like a tongue twister this morning, looks like, and it actually is growing. I mean, we can't deny the fact that it is growing. So even though we have very low inflation and we have very low unemployment, it is growing. It's little bit. And I think they did actually have the number on this morning. I think real wage growth was maybe 2.5. Yeah,
2.5%. The expectation was that for the month was that the rate that the increase would be 0.2%, and it was 0.1%. So they were off by 50%. So, you know, these are little teeny numbers, but a minuscule change in a little teeny number can be a 50% change.
But that's not something that's going to impact the equity markets. It's not something that's going to impact the broader bond markets. I mean, those sort of micro, those are macro trends. I get it. They're micro looks at macro trends, but they're not having an impact on our broader markets because there's too many other factors that are impact. Is my take.
Is that right? I got it.
I mean, the markets didn't move at all this morning based on those job numbers. They didn't move.
Well, they did a little bit. My number, which is the 10-year Treasury, hit 2.10, which
really?
is the
Went
lowest.
Down.
Which is the lowest.
Yeah.
In other words, there was a bond surge,
Mm-hmm.
a price of bond surge, and yield went down to 2.1.
You think we'll break 2 again?
I think so.
Really?
I think so. I think that we're in an economy which is extraordinarily, it's operating in very, very tight bounds, and with no good explanation of why inflation and wage growth and economic expansion has all been operating in such a tight band. The only explanations that I've read that make any sense are super kind of graduate level intellectual explanations. In other words, they don't bear much on what we do every day. Mm-hmm. It's explanations like the broad demographic shift in the country.
Definitely.
The broad demographic shift in the workforce.
Well, I think the politics probably plays into it as well.
Or
the lack thereof movement in politics.
Lack of movement. It would have helped shorter term if we had an infrastructure plan and the first $100 billion of $1 trillion to come was being spent on infrastructure as we speak, as we stand here. Mm-hmm. Of course that would have helped, but it hasn't happened, and the broader trend is toward an economy which is not growing very fast, and the economic shift is occurring worldwide to the economies that have basically younger populations. India, Malaysia, certainly China, certainly several countries in South America, although they've kind of stumbled recently.
A little, just a tad.
Just a tad. But our birth rate and the overall demographic aging of our population, the structure, the kinds of jobs that we have here, all of that has shifted enormously. Mm-hmm. And it would appear that our economy, our GDP, is going to stay resiliently in that 2% growth range, 2.5.
That's the new normal, and unfortunately, at that rate, that's not enough to support a lot of the infrastructure plans that have been posted.
That's right, and that gets us smack dab into politics, which we can decide on the break whether or not we really want to get into. Because if you really buy into the 2% growth rate, then you really have a difficult time having a tax restructuring that causes...
which is intended, of course, to support the infrastructure and it's a greater growth.
Greater growth.
The catch-22.
Yeah, it's a catch-22. You've got to have greater growth in order to restructure the taxes. And
we don't have it.
We don't have it. So
not with these numbers anyway.
Not with these numbers. Mm-hmm. So it's going to be tough. And without staying resolutely non-political, within the Republican Party, there are a significant minority of legislators who will not support the core principle of tax restructuring unless there's money to pay for it. So you're not going to get the votes ultimately, and we're going to stay in this kind of stasis of political lockjaw. At least that's the way that it looks.
So on that positive note.
But it is positive. We'll talk about positive stuff after the
There we go. So please stick with us. We'll be right back with more Money Matters.